Jeremy, and second up for that. Bill, thank you. Those in favour, please say aye. Aye. Carried. Confirmation of minutes of the last meeting, 14th of December.
I'm going to move those.
Any questions, discussions about that? Second up for that, Bill, thank you. For those in favour of approving those minutes, say aye. Aye. Thanks. Carried. Right, now we have the Southport minutes to approve as well. I wasn't aware of this, but apparently if we have one of these meetings before the council meeting, then we get to approve them. Otherwise, they go straight to the council meeting. And it's going to be finance. Would like to move those. So is there, would like to second those, Alistair? Thank you. Those in favour of approving the Southport Committee subcommittee meeting, please say aye.
Aye.
It's carried. Right, we're up to extraordinary business. Supplementary reports. Those. Questions? No questions? Any councillors or chairman? I don't think reporting the councillors' reports. Those. Right. So we've got the JB Weir people here. And they are Tom Phillips and Bruce Robertson. I think we've all got one of these, so we can invite them in now. Oh, thank you. All those in the meantime, which comes.
Doing item 3.
Yes, we're going to item 3.
Good morning.
Thank you for coming down to see us. So we're in your hands now. We've been sent your report, and we've got it on your screens and a hard copy as well.
Okay, thank you very much, Morris. My name is Bruce Robertson and Tom Phillips from JB Weir. I'm a managing director with JB Weir, and it's a pleasure to come down and run through the figures with you. The type of format I'd like to have is that Tom will run through the specific performance figures, which are always important. Just where we've come to for the 7 months here. We'll look back a little bit further, and then we'll talk about where we see the next 12 months, because that's more important about where we're heading into and what the markets look like. As with everything we do, the key to all of our investment is we hold quality investments, and that's one of the key things to get you through what are pretty tough times, globally as well as domestically. So quality in our portfolios, diversification in our portfolios, and always taking a very measured approach. So we expect good returns, but we actually plan that things are tough and they may not come about. So key thing for you at the moment, let's look at the performance, Tom. Right, and by the way, if you want to ask questions as we go along, or would you like to save it to the end? I always say ask as we go along, because then you remember it and you get to the end and you might think, like, gee, what was the point I was going to make? So
yeah, okay, no, well, we're happy to do that. We'll just see how we're going time-wise. We've got about half an hour. So if people are happy to do that, just butt in, and we'll see how we go. Thanks.
Thank you. Thanks, Morris. So hopefully you can see, I know that these might not have been provided in your board papers you received prior to the meeting, but the difference between what's in here and what you've got, these numbers are updated to 31 January, and it shows the financial year to date performance up to date as we can get. So in summary, the portfolio value at the end of January was just under 28 million. So for the 7 months of the current financial year, you've had a capital return of 730,000 and cash income of 470,000, given a return of 1.2 million or 4.5%. And I guess just while we're on that, it's worth reflecting, obviously, calendar year 2002 was a really tough year for financial markets, and we'll come on to talk about it. But those asset classes we think are safe, like bonds in particular, had a very poor, return. So we run the portfolio based on a SIPO, and that's a relatively conservative one with a 50% weighting to cash and bonds and a 50% weighting to growth assets. And we'll come on to talk about that in a minute. But what's done well for the portfolio has been the equities, the shares, the growth part of it over the last 7 months has been really strong. So international equities have done 5.5%. Australian equities have done 14%, and that's really been driven by the resources being strong. So Australia benefiting from China reopening earlier than we thought. And also boring New Zealand equities have done very well. So, likes of Fisher & Paykel Healthcare and, Infratil, which is an infrastructure manager, have done well for us. This chart here probably sums it up well about how we're going against the benchmark. So it's important to see how the portfolio is going against its benchmark. And we've previously provided figures to Tanya, which I think have been shared with council, about how your portfolio ranks, if you like, with the peer group. And we'll talk about that separately. But the way to look at this table is you can see, for example, New Zealand equities have done 14.25% for the 7 months. We've got an 8% weighting in the portfolio to New Zealand equities. And the benchmark return is 10%. So you've got an excess return over the benchmark of 4%. So at the bottom here, you can see the portfolio has done 4.52%. The benchmark return is 3.8%. So we've exceeded the benchmark return by 0.72% for the first 7 months of the year. I think the SIPO's got one objective, which is to return the risk-free rate, which is the New Zealand Government Bond Index by 3% per annum over a 5-year period. And the rolling 5-year return to the end of 31 January is 32%. So effectively the portfolio has done that over 5 years. And the government bond rate over that period has done about 2.5%. So it's well exceeded that.
Just on that, like that's the end of January, it's quite different results to what we've got in our papers for the end of December. So equities have obviously improved significantly because those figures are much more positive against the benchmark as the ones we've had in the nettle.
Yeah, there's sort of two parts that Nick, it's unfortunate that the ones we've shown you are different from what's in there. But one is that the month of January is very positive for the portfolio. So it was up about 1.3 million. And it just shows how quickly, quite a lot of people talk about, you might hear about missing the down days in the market. It's far worse from a portfolio sense to in fact miss the up days, because markets tend to rebound pretty quickly. So we've seen that in January. And also these numbers are just 7 months. I think you've got a rolling 12-month one there, which is last year. Okay. The market was obviously very weak in the first couple of quarters of 2022.
See, Tom, I know it's not good to look at it day by day, but in the last couple of days in New Zealand, index has dropped away quite a bit compared to it was rising nicely and then it's gone back. So it's still pretty volatile. Or do you think it's still on a upward trend? So just the really specific factors for the New Zealand market over the last couple of days has been Ryman, which is one of the sort of top 10 companies in New Zealand, has done a big capital raise. So they raised $980 million at a big discount. So what happens then is a lot of managers need to sell other shares to take up their rights there. And so that put downward pressure. And also A2 Milk, which is a top company, had a result which was actually in line with what they guided the market to, but some sectors have been disappointed, so that sold off as well. So we've had sort of specific factors on the New Zealand market. And, and just while we're on that, the events of the last fortnight here in New Zealand, particularly the floods up in Auckland and the effects of the cyclone, we don't think have a big effect on the New Zealand equity market. It's quite an insulated market in terms of 40% is the gentailers, which aren't affected by those issues, and then it's companies like Fisher & Paykel Healthcare, Mainfreight, very much global businesses which aren't necessarily affected. So the New Zealand share market is quite different from the New Zealand equity market, from the New Zealand underlying economy, which is probably more driven by factors about where interest rates go. And obviously the Reserve Bank today is going to come out with an announcement. Okay, thanks.
The very same reasons why the US markets are correcting at the moment too, is that interest rates are going to stay up higher, another couple of rate increases, and those rates are going to stay around for longer. So even the international markets are being sold off as well. But that interest rate inflation environment we'll talk about a little bit later.
So this just shows the current asset allocation. So as I said at the outset, we've got a 50% weight to income assets or cash and fixed interest, and a 50% weighting to growth assets, which is shares or equities. Currently, we're sitting just slightly over our cash balance. Happy to hold a bit more cash when we're getting paid, 4.25. It should be 4.75 after today. So, if you think back, even 15 months ago, we were getting less than 1% on cash. Now we're getting 5 times that. So cash has actually become an asset class that we're more comfortable holding. And in terms of the equities, we've got a slight overweight to New Zealand equities, which we're comfortable because of the income characteristics. We get about a 4 to 5% cash yield from New Zealand equities, so it provides this type of cash income, which can be spent. Just a note there on responsible investing. So, for the portfolio, we exclude those exclusions that are noted there. And we can confirm that there's no breaches against the SIFO at the moment.
We haven't got oil companies or fossil fuel companies in there. Is there a reason for that?
No, we haven't got those as a specific exclusion.
We would have to direct you to change that, wouldn't we?
Yeah, we would want to work in consultation with you to do that, just so that everyone was aware of the consequences of what that would do.
Right. Do you have a comment on that at this stage, whether that's a good thing to be out of or to stay in, given the potential problems with fossil fuels into the future?
Yeah, so I guess a comment would be the world's moved over the last 5 years from having a direct, a direct exclusionary policy. So 5 years ago or 6 years ago, the way that ESG was sorted is you don't own fossil fuels. Now the world really do well. You want to own transitory fossil fuel companies. So a good example here in New Zealand is Contact Energy has about 15% fossil fuels still, so it's still got some oil and gas assets, predominantly hydro, but it's transitioning away from that. So if you had a strict policy and you excluded them, that would mean you couldn't own a company like Contact, which is seen as being a best in breed for transitioning away from bad fossil fuels to good. And so the way the current global thinking is, sometimes it's better to own some of these transitory companies doing good than not to own them. So I guess my comment would be, we'd be happy to work with you in extending the exclusions if need be, but we want to keep it fixed.
Yeah. Okay, Jeremy.
Obviously the energy sector's doing exceptionally well, thanks to Putin. But I was just going to go back to the interest rates. Obviously, we're getting to the point where our interest rates are almost what our long-term average. I think we're always in our long-term plans 4.5% or somewhere around there. Is that what we sort of hope to achieve? Is there a little bit of you could take risk out of our portfolio, right on the bank, so to speak, rather than putting it into the markets? If the interest rates are going to be sitting really strong for a couple of years, just trying to take the risk out of as long as we're probably getting there.
And it's really good.
We're happy. That's what we're playing.
It's a good point, but again, if you're trying to de-risk your portfolio, you don't put all your eggs in one basket.
It's just about trying to tweak things. I mean, we did that a few years ago. Take a wee bit of risk out.
Yeah, I think the way to take risk out is to be really fully diversified, and especially for particular entities like yourselves, to have a big weighting in New Zealand. You've already doubled up your risk because you've got all your assets in New Zealand already. So if you had a major event like we just had in the Hawke's Bay, you definitely want to have assets outside of the New Zealand dollar. So we still believe the equities will deliver better returns going forward than even when your interest rates are moving up, because at some stage the economy starts to slow down and interest rates will come back down again, and that growth will come through into your equity component. So equities will still deliver you better growth over the long term. It just feels comfortable being in cash when rates get up. But what about if rates go up even more and we lock into bonds at 5% and rates go up to 6.5% or 7%? And people can't rule that out because there's always those outlier type of outcomes. So the reality is we would still argue for a very diversified portfolio because as much as Tom and I think we're pretty good, we don't actually have a really crystal clear vision of what's going to happen in the future. So the best way to de-risk it is make sure we're diversified geographically and asset class wise. And that's proven to be the right thing to do for the last 100 years. And I don't think we're going into a time frame where we'd say, put it all in the bank or put it in cash. If we did believe that, we'd come and say that.
Yeah, I think we're coming into unknown territory in regards to where the interest rate, the debt levels of New Zealand householders. Personally, how it's affecting us.
Yeah.
And the flow on effect of the COVID loans coming off this year and things like that. The housing market, it's I certainly don't mind having a bit of money overseas because nobody really knows what's going to happen within internally.
Yeah, that's
So
right.
interest rates are going to really affect things.
Yeah, and what we try to do is, when we look at the portfolio composition, the type of companies we have in our portfolios are pretty inflation proof. So if you think about your electricity costs in your household or your food costs, we're countering it on the other side because, look, I've got to be honest, the cost of living is just getting incredibly expensive. I popped out for a coffee this morning. It was $6.50 for a coffee in Invercargill, and I go, that's the same prices as Auckland. That's becoming the norm everywhere. So how do you insulate against inflation? You've got to have exposure to those companies that are actually producing those products and can pass those costs on. It's a pretty difficult tango dance that you're doing within your portfolio construction. But I think the assets we've got are really good assets.
Yes, I guess just to finish that, and it's interesting for just from a portfolio construct, we have basically 50% of the portfolio outside of New Zealand. And look, the reasons for that are pretty self-explanatory. I think the events of the last fortnight we live in an area of the world which is subject to weather events which seem to be a lot more frequently than 1 in 100. And we saw, what happened after the Christchurch earthquakes, what happened with COVID is that the Kiwi dollar in particular can move around and parts of New Zealand can be very susceptible to what happens when we have a shock here. So that's why we want to invest in companies outside New Zealand that are global and they're going to continue to deliver us earnings throughout any cycle and preferably in a different cycle than what we have here. So we haven't got our eggs in one basket. Take what you're saying about it's comfortable to have your money in cash. This table just can jump around, but this one here just shows a better risk reward for fixed income. And I guess it's to your point, in markets we love, we love talking about acronyms. We used to have TINA, which is there is no alternative, there is no alternative to investing in growth assets or shares. So what we're calling TARA now. There are reasonable alternatives. And the chart on the right-hand side just shows where bonds have gone. So, going back 8 years ago, 2014, we were getting 5% for bonds. And it fell all the way down to we were getting sort of 0.5% for bonds just 18 months ago. This has been a phenomenal rise. To put it in context, the return, this is a US chart going back 200 years of US treasuries. So like our government bonds. The return of US treasuries in 2022 was the worst since 1788. So I think it just shows that last year was quite unprecedented for financial markets and in particular for bond markets, which is supposed to be the safe part of the portfolio. And so I guess the chart on the right just shows how quickly interest rates can move. And to your point, Jeremy, if we go all to cash, this could change around and come back very quickly and we get left caught short, if you like. If the interest rates drop, then in theory equity should go up. So we still want to have a bit of a balance, but we are noting we're holding a little bit more cash than we would normally. Yeah, well, we'll just talk about New Zealand while we're here, right? I think for New Zealand, we think that this is on page 15 at the end there. We're still quite attracted to the New Zealand market because of the income yield that we're getting from the New Zealand equities in the portfolio. So we think the RBNZ today will go 50 basis points with some sort of message that we've got further to go. Still, fairly worried about the housing market in particular, and the fact that we've still got full employment. So you're seeing wage growth, inflation is definitely coming through as you're seeing the minimum wage continues to go up. And our view is that the response to the events of the last fortnight should be a fiscal response from government rather than central bank interest rates, which could have the effect of making inflation go even higher. So the central bank's core role is to get inflation down. We think inflation has peaked, but it's going to take, it peaks at 8%, it's going to take a long while for it to come down to that 2 to 3% band. And so we've got to keep these high interest rates for a period of time, and we think that they're probably going to stay higher for longer. So, could be in that sort of 4% range for a good 18 months, 2 years, just to try to really get on top of the inflation before they start coming down.
Thinking about the New Zealand market, I see on page 3 that about New Zealand equities at the bottom there, the key detractors were Ryman Healthcare, which would be a lot, in Port of Tauranga, which was 2%, 2.4%. Thinking about Port of Tauranga, it's meant to be our guiding light, a really good port. What would be the reasons behind that poor performance?
So Port of Tauranga it trades on quite an expensive multiple to start with, Morris. Trades on about 26 times earnings, which is quite expensive for an infrastructure, type asset. And I think it doesn't pay a huge dividend. It's about a 2.5% dividend yield. So it's not but if you look over a 20-year time horizon, Port of Tauranga has done a total shareholder return of about 15 or 16%. So it's just having a bit of a blip in it. And I think as the market's rotated to companies which were probably out of favour and were hit hard. So Fisher and Paykel, you can see there's up 30%. But if you look back over 2 years in COVID, that got to like $36 and fell back to $18 and it's bounced back. So it's more been a rotation from some of the defensive companies, which we call Port of Tauranga, to more of the cyclical names, which is those 3 that are up there. So nothing to worry about it. It's more just the fact that the market rotated a bit from cyclical names from defensive to cyclical.
Just simply valuation. It's expensive stock, and so fund managers like us look at the stock and go, okay, if we're trying to get an 8 to 12% return out of the market, that stock looks pretty fully valued, and that's what the market. You're great company, great management, we love the company, but from a valuation perspective, we can find better upside from buying into another play. So that's what you're trying to do all the time in the portfolio. You'll still hold it in your portfolio, but you might overweight it. So that's a valuation argument.
Any other questions on any of those names while they're up there?
Probably not on the names, and I guess as councillors, I don't want to be second guessing the market. That's actually why we hire you guys. And I guess my question coming into this meeting is, are you comfortable with the flexibility in the SIPO, given that we are reasonably conservatively geared, has performed remarkably well through the earlier financial disruptions we had, and appears to be doing the same this time. So you've got we have changed it once because it was fixed, but we put a bit of flexibility into those. The last one we looked at it into those areas, so you had a bit more flexibility.
We're comfortable with the amount of flex in there, Nicola. I think it does need a bit of a review around some of those return assumptions which were put in place in 2016 when interest rates were very high and inflation was very, very low. And the reality is now we're in an environment with rising interest rates, but extraordinarily high inflation. So I think, before we look at a SIPO, I think you're trying to put together a document that's going to last, 5 to 10 years, not just for the next 6 months. So it does give us enough flex to move. But I think some of those return assumptions need to be re-looked at, which I think is a bit of work that council's got underway.
Just So the key thing, like Tom's gone through performance, and that's what people focus on, but it's actually about the risk management, which Nickel, that's what we're doing inside our SIPO. You know, we are conservative. We're very measured in the approach we take. We don't go down to the small cap companies. We stay with the larger cap companies. We stay with the companies which we think have got good management. And 9 times out of 10, the management's doing exactly what we're all doing here today, looking at how their board is going to manage the returns going forward for the individual company. And so quality always comes to the forefront, especially when you have market corrections. So the big picture in this economic outlook for the next 1, 2, 3 years is all about inflation. And people keep saying, why does the Fed keep lifting rates? You know, things are starting to slow down. And you go back to the 1980s and we can remember how inflation got away wickedly. And remember, we had mortgage rates, interest rates up at 20, 23%. And we don't want to go back to that scenario. So the Fed's being kept their foot really firmly on, hey, inflation is the number one problem. It's the number one problem for the mass population because it really hurts people on the bottom rung. So we've got to get ahead of inflation. How do we get ahead of inflation? Well, effectively, they're going to engineer, hopefully, a mild recession, okay? Because that's really what's going to try to clean out the excesses. That's already starting to happen. But in labour markets, labour costs are still really high and going up. So again, overnight, we had a correction in the US market. And again, you're going to see that interest rate's going to have to keep going up further. And as Tom touched on earlier, interest rates go higher and they're going to stay up for longer because once you get inflation above 5%, it usually takes 5 years plus to bring it back under control. So a lot of people are talking that inflation is rolling over. It is starting to soften, but it's still there. You know, inflation's everywhere. Everywhere you spend money nowadays, it just seems ridiculous. If you look at a hotel cost, which 3 years ago was $180 a night. Now it's $380 a night. You go, God, that's inflation. You're really starting to feel it. So all the central banks are on the same page. They're going to keep those interest rates up. Tom's correct. Inflation will start to drop back from those 7 to 8%, maybe down around that 4 to 5%. But it's going to be really hard to get it back inside that 1 to 3 type of level. And even central banks now are talking about maybe 1 to 3 is not the ideal part. Maybe it's something like 2 to 4. So interest rates start longer. The key thing for us is the companies that we've got and the asset allocation we've got, is that appropriate for you? And we think it is. We think the growth on the growth asset side of the portfolio, those companies are going to deliver. And as inflation goes through, they can pass on some of those costs, but there might be a period of subdued growth. Okay, and I always say that our portfolios, we hope to deliver somewhere around that 8% benchmark. At the moment, we had a very strong lift in January. That's probably going to soften off over the next few months, but it's still going to come through by the end of the year. I still think we're going to see better outcome at the end of the year. The global inflation polls, as I said, has moderated. Got China coming back into play. They're back buying goods again. They're back after the COVID lockdown. That's been a positive for the economies, global economy. And we've seen that whole growth inflation mix being a much more better balance than it has been for the last year or two. Maybe go through, I won't go through each of the pages here, but the key thing is Europe's ended up being a better outcome than what we thought. You know, with the Ukraine-Russia crisis, we thought it was going to be a terrible winter. The winter was quite mild. It's actually panning out quite well. There's actually looking at European companies doing better than what we thought they were going to do. Global growth is being revised upward, only moderately, but that's a plus for us as well. Next slide again, Tom.
Yeah. So what's changed from even say 3 months ago is that, and to your point earlier, Jeremy, about natural gas prices and fusion, like we were quite concerned in the last year that Europe was going to have a cold winter, natural gas prices were going to skyrocket, and that was going to have put Europe in a deep dark place. Natural gas prices are now sitting below the level before Putin invaded Ukraine, so that's been positive. China reopened in November, just like that, much to everyone's surprise. Whether it is just like that, we don't really know, but it's open and they're buying commodities, particularly iron ore and things that they used to buy a lot more of. And so that's a positive. And the third is that there are signs, and we just say signs, that global inflation is starting to moderate. And and this is the bit, so I think Bruce mentioned, I might have mentioned before that, we hope that central banks don't cut rates too soon, because the big problem in the US market in particular, it's the same here, there's still 1.9, almost 2 jobs advertised for any worker looking for a job. So there's just no slack, and it's the same here. You know, we can't get workers. We haven't got enough people that want to work, and so that leads to wage growth inflation, which is quite hard to get under control once it starts to happen. But you know, the fact that inflation started to tick off gives us confidence. That last bullet point, that we're going to have a soft landing, i.e., that central banks can engineer this gradual slowdown rather than putting the brakes on, putting the economy into a recession and being stuck there for a while.
Maybe just also highlight that the New Zealand exposure we have on the New Zealand market doesn't reflect what happens in the New Zealand economy. It's actually quite different. We don't have most of the companies in the economy represented on the share market. They're mainly gen retailers and companies that keep ticking along. Your Sparks, your Chorus, all those companies keep ticking along. Even though the economy can feel like you're going into a recession, the actual share market can actually still outperform. So that's quite a difference that you think of. Probably other point I want to finish. I'm not sure we're okay for time, 30 minutes. So the key thing for us when we come down and present to you is to highlight that the underlying companies and exposures we've got for you are quality. Okay, we don't have any rinky-dink companies. We've got good underlying companies, and we're performing against the SIPO. We're doing well against our peers. We're diversified, because diversification is the key to this whole risk management with the quality. And I think that if we look forward to the next 12 to 18 months, there's absolutely some big obstacles out there, but this portfolio will get us through the next 12 to 18 months. Now, 1 or 2 meetings we've been at, people said, well, what about if there's a nuclear, Russia and Ukraine? Well, who knows what the outcome of that is? Probably no portfolio is going to come out of that one if we have a nuclear meltdown. We haven't talked about China, Taiwan, because way above our pay grade. But the reality is everybody's a little bit nervous about some of these geopolitical risks that are out there. Russia has been an absolute shocker to see that happen. But the West is dividing up very strongly and supporting Biden, UK. There's different political lines being drawn. So our best thing we can do is make sure we've got quality, make sure we're diversified, make sure our asset allocation is correct, and that should actually hold us in stead for the next 12 to 18 months. And we're reviewing this all the time, looking at what we've got.
Any other questions? Well, run over anything here.
Would just say, well, I was to say that, make a comment that obviously we've done pretty well over the last 100 years. Relaxed at what you're doing for us, anyways. You're explaining it quite well. As I say, we don't know what tomorrow will bring in regards to what happens around the world. We'll deal with that when it comes along, but everybody's in the same boat anyway. So in regards to those sort of things, but I'm pretty relaxed. Like it's good and so on.
The one thing, Jeremy, we don't make out we have the answers to everything, and when we certainly don't, but we've been doing this since 1984. Being far too old to be doing this maybe, but 1984, and I think the boys worked out the other day, we've been through 19 crises, significant crises since 1984, and our portfolios have come back up again. They go down, and it feels really bad at the time, and there's that immediacy effect that you think, oh God, the world's going to end. We've done it 19 times and we've come through it. 2008 was actually scarier than what we've seen last year. And again, when we go through this, when we go look at the Hawke's Bay, you go, God, how will those people come out of that? But hopefully in 18 months' time, you're going to see orchards back on their feet, orchards back up on their feet. So, we've been here, it's different, but if we stick to the strategy we have, we should come through. Can I just finish, Morris? I got up this morning, went for a walk around Invercargill. Absolutely impressive what's happening in the city. It's got a real buzz to it. And I must admit, the productivity must be quite strong here because the workers are on the working side in the precinct, your building down there? They were out there about 6:30, 7 o'clock and full teams working. So very impressive. It's looking fantastic, the city.
Yes, no, it is. I went for a walk myself there, first time actually, I must confess, just on Friday, and quite nice walking around there now, even though it's not completed.
Yes, very much.
So Jeremy, I mean, for us and Morris, it's important that we come down and, talk to it's very easy to get a report back from management, and the numbers don't necessarily tell the full picture. So we're always happy to come down and have a chat. And I'll just sort of finish by saying, Tanya was asking how much money we've taken out of the portfolio. So over the last 5 years, there's been about 12 million has come out of the portfolio. And over that time, you've had capital growth of about 4 million and income of about sort of 4.5. So the portfolio is there to, I'm not necessarily sure what it's there for, but it's there to help. And it is generating income and capital growth. It means you can do what you need to do with it.
Yes, well, we've got our annual plan deliberations coming up, so getting a bit extra out of that is important. I wanted to ask you about the graph on page 13, which I don't really understand, the one on the top right there. Yeah.
Okay. So what this chart is it's trying to show. So AS is an aggregate supply and AS is an aggregate demand.
Not gravel, obviously.
What's that?
Not gravel,
Not
obviously.
gravel, correct. This bit here I've got a little pointer on is what we call a kink. And I guess the kink is how much growth up here has to fall before we get the sort of equilibrium where central banks can cut rates to a level that is sustainable long term. So I guess it's kind of as it says there, that second bullet point, we're in this sort of three-way tango between inflation, central banks, and the size of growth and labour market trade-offs. So right now we know we've got inflation which is peaked, but it's very high, or we think it's peaked, but it's very high. We've got central banks whose role is to control inflation, not worried about fiscal, just worried about monetary policy, and the growth and labour market trade-offs. So when we talk about that, as I said before, at the moment there's 2 jobs advertised for every unit of labour. So there's zero capacity in the labour system. And the growth bit is that's why we focus on companies' earnings. So the US earnings season is going on right now. And it's really important that we look at companies' earnings to see that they're still growing. Because if you're in an environment where we've got reasonably high equity valuations and earnings don't support those valuations, then the prices have to fall. So I guess what this chart has shown is it's like an imaginary kink where sort of aggregate demand and supply reaches that sort of neutral area where ultimately really is where we get back to inflation in a 2 to 3% band. So when that happens, it's probably sometime late in 2024. It's a while away. Did that answer it?
Sort of.
Not a good answer though.
The answer is we're going to have higher interest rates for a long time, Alistair.
You've got to stifle demand. You've got to stifle that demand.
Yeah.
Tony and Wilma, did you have any questions? You would have asked them, I suppose. But...
Oh, no, that's all fine. Thank you. I ask mine on a regular basis.
All right. Well, thank you very much, gentlemen. That's very good. And yes, it's all looking well, a bit uncertain as they always are, but not too depressing either. Oh, Nickel.
Just thanks for coming down. The good communication you provided us with is very much appreciated. It's one thing to get quarterly reports and you're looking at the figures, but it's actually usually hop on an aeroplane and come down to see us and answer the questions, and that's very good. We really appreciate that, and we look forward to you continuing to manage our funds in a profitable way. So thank you.
All right. Thank you.
Thank you very much.
Right, now we'll go on to item 3. Of,
I'll move the recommendation for item 3, Mr. Chairman.
I'll have it seen.
That's item 3. Now back to item number 1, the financial report to the 31st of December last year.
I'd like the
You want to
Say
vote
aye.
aye?
Then we vote on that. That's item 3.
Aye.
Okay. We're right now. No? Yeah. Right. Okay, this is the financial report. Who's reporting on that? Tanya?
Sorry, Chair, I was down the room. Are we doing the investment report, which is item 3?
That's what I was checking. We actually finished it. But,
Yeah, I thought we'd.
Although the one were part of the presentation. I mean, it will only take a minute, but.
Yeah.
I'll just assume that you've read the report and that you've got a more recent update. So the report here was to the 31st of December. And as was pointed out by Nicole, that minus 8.35 was the rolling average 12 months to the 31st of December. But with a substantial change in the market in January and the market values, the rolling average is minus 2.8. So big lift and incredible volatility is all we can describe that continues. I'll refer you to the graph on page 76. The red lines under the zero are the months of negative value change in the portfolio, and the red bar above, in the 12 months to December, there was only 1 month above. And of course, if we extend that now to January, you'll see a significant change greater than that. So timely, very timely that the our investment advisors came down. The changes in the market. So I won't labour the report. It is, we've had a bit of update from the JB Ware.
Thanks, Tanya. Sorry, I was got a bit lost there, but I think I'm on the right page now. So have you got any questions on Tanya's comments? We're all on page 70, 73 it starts.
Yeah. 74 to 77.
I didn't have anything.
they updated it anyway, so we're in a better place now.
Perhaps I
Okay.
could add, Chair, that we still have reasonable cash flow invested currently. We are earning good daily rates, luckily. Have been earning 50 to 60,000 a month in income. We're just investing our cash flow and we'll talk about the cash flow report in another item.
So just to clarify things for me and possibly others as well, in terms of the money earned from the investment portfolio and our ability to use it for paying for things from the annual plan process. Can you just remind me of I know that there's growth, that some of it we can't use and some of it we can use.
So we're budgeting to use what we call realised income, and I appreciate that's a technical term, but it means dividends and interest that is earned by the portfolio from the companies it's invested in. That is physically received by JB Ware and banked effectively into the value of the portfolio. Yeah. So we aim to earn, I think we budgeted 600,000 a year. It says in here we're on target to earn 800,000. There is $200,000 of total costs, which is the management fee, transaction costs, and the other fees and taxes. The remainder then is attributed, first of all, to some of the reserves that are interest earning reserves in our balance sheet. So the reserves held by the catchment groups and disaster reserves are the two primary interest earning reserves. So they will earn, now they were earning only 1% until last year as the deposit rate. We'll be crediting them 3 to 4% this year. And any remainder is available to subsidise the general rate. And that remainder is not large, and so when we take 800,000, subtract 200,000, take another 300,000, we've got 200,000 or 300,000 depending on how it goes. Which is available, which is at 2%, 1 to 2% now of the rate.
All right, thank you. Any other questions?
I was going to make a, we didn't have before though, like, it's better than why because the interest rates, we've actually got more realised gain with interest rates.
The purpose of the portfolio is to maintain the purchasing power of the reserves. Because in that portfolio, we have the reserves I've mentioned, we have other asset reserves, and including the $7 million of leasehold reserves. So.
Right, okay.
Just one that could probably puzzles people a wee bit, but when you look at the negative thing for the bonds, when interest rates go up, actually the value of the bonds goes down, doesn't it? Eventually it comes right, but if it goes the other way, the value of the bonds goes up. So that's why those things are showing the,
Yes,
it's a bit like the equity thing, you're not actually selling it, but the value is off.
During last year, I did quite and the June report, I did quite a unique article from the council on that, because as our speakers pointed out, for the first time in 200 years, bonds have been incredibly negative return, and that is unusual. If we have a portfolio of bonds and equity, because they offset each other, and in the last 12 months they both went in the same direction, and that was because of the steepness of the increase in interest rates. If we were to sell the bonds now, you would be actually selling them at a discount. If we hold those bonds, they eventually become value closer and closer to the original investment. The only way that those bonds would go down further now is if interest rates skyrocket. But ultimately, it's only the market value, the intrinsic ownership value of those bonds remains the same. If we've invested $100, we're getting $100 back. They're a very interesting asset class.
Right, now, is it true that we've actually resolved to note that we've done it? Right. So now we go back to item 1. Is that right?
Yes.
Item 1, which is on page 14.
Final report for the 31st of December. I will note some of the commentary and take the most of the report has been read, Chair, if that you're okay with that, stay with in time. The report shows that we are operating ahead of budget. I'll read the summary, it might be easy. The reserve was 1.1 million versus a budgeted deficit of 2 million. As a result of this, the positive monthly result operating deficit for the year has been reforecast from 7.7 million to 4.6 million. So that summary we put in there to bring the focus to what is going to be the impact on the end of year results. Often we get a quarterly report or a half year report that shows a variance as we are here. And then we want to project that to the end of the year and see what does that actually mean at the end of the year. And Chair, I'd like to focus on the end of the year and just point out two things that are going to make a difference. We are effectively forecasting a $3 million better than expected result. And that is overall When I say forecast, that is the best information we have at this time. Two key items. One is that, again, we will have a $1 million variance in the people budget. Seems like a lot, but it's actually 5% of the budget. And that is changing month by month. In August last year, we had probably our lowest period of vacancies, or the most vacancies available. Every month since then, our vacancy rate is returning closer and closer to normal, what we call normal before COVID. That is going to be normal.
What is normal?
We used to be 4 to 5% under our budget traditionally. Amy's not here, so she measures it in a different way in terms of rate of vacancies positions, but I tend to measure it against the budget. To the point where I'm not authorising many approvals for staff at the moment. So we're in a much more settled period. Still some vacancies, some new recruitment, but this is changing. Be aware of that. But nevertheless, up until December, it was the $600,000 variance that you see here. We're saying that variance will be half in the next 6 months, but it'll total up to around $1 million. The other variance to budget to note is the fact that we have cruise ship income. Now, in the December report, it's only 1 month of cruise ship income. It was, in round numbers, $550,000. We are forecasting net amount of $2 million to the end of June. And end of February, end of January, we were at 1.4 million. So if we just focus on those two numbers, other than that, there are ups and downs of operating. They do tend to set each other off. So we'll focus on those two numbers that make up this $3 million forecast difference.
Okay, Alistair had a question, I think.
Does $1 million represent 10 people? They cost about 100 grand each.
The cost varies, and
And I understand that, but on average, what would that come out at?
we could say that it's not the average salary of this council.
No. But then, and also in that, there'll be the costs of running them too, won't
There is always a 20% additional cost, which is all the add-ons, as you say, the leave saver insurance, all those other things. I would suggest it's more than 10, but it's happy with 10.
Is the cruise ship forecast slightly conservative? I'm thinking that the last change, we should be getting more revenue per ship with the biggest ships. And if we're getting the similar numbers, we used to get I thought we could have got closer to 3 million in a good season. You don't know about weather and whether they'll all get there, but
London advises me that the increased charges are coming in next season.
well, they're not in the yet.
Okay. There's some transition to tonnage. So we took his forecast, and I think it was this year's less than next year. We've discounted it by, I think, 300,000 to 400,000 because there's always cancellations, and we've experienced some of those already based on the biofouling. Previously, it used to be discounted because of weather. Who knows that we could still, according to our catchment manager, we could still easily have a tropical storm out of the Tasman. So that could take out a couple of weeks of cruise ships. So to answer your question, Chair, it is conservative, but it's not outrageously conservative.
So we been something like that agreement was signed just before COVID hit. I'm wondering why there's still a year's lead time.
Well, I'll follow that with him, but he mentioned the transitioning, and I assume from that not all the ships are. I can clarify. He's certainly the expert on the deed.
Certainly was a look, but did it get signed then? Or was it?
Signed in October 22 by the industry.
It was only last year, wasn't it?
I'm thinking Lucy is online, Chair. I'm not sure if she's on or not, but she might be able to answer that question. Will you?
Because there was a cap under the old thing, which meant the larger ships weren't getting the revenue that should be. So,
Kia ora, I'm here and I didn't hear the whole question. If someone could repeat the question, I might be able to assist, Chair.
When is the cap tonnages being removed? Is it this season or are we transitioning?
Sorry, I'm really struggling to hear you, Tanya. The cap on the tonnage?
Yes. The previous deed had a cap on the tonnage of the size of the ship and that was removed or increased. Is that in effect this season or next season?
It's, I believe it's next season. I'd need to double check, but we gave them a period of transition so that we didn't immediately implement it. So it tapers out rather than just being completely removed kind of cold. So I can double check that, but and give the councillors more detail on that process if that would assist.
Thank you, Lucy.
Yes. Well,
Chair, can I just say that we're actually speaking quite quietly in this room.
Yeah.
And so all my colleagues online, I asked them the question, could they hear you? And the answer is only intermittently. So if we have the public listening, they're probably not hearing our conversation.
right.
So we might just need to speak up a little louder. Thank you.
Right, any other, sorry, no, you go. I was just going to say, are there any other questions? I think I had a couple, on the table on page 16. The numbers in red, F and it's favourable and unfavourable, isn't it?
Yes.
Okay. So in relation to the capital government funded projects, there's some fairly big numbers there. What's the situation there? Does that mean that we haven't been funded yet, and we're going to be?
Always it's in these situations, it's difficult to determine the timing of these projects so far in advance. So this is a timing issue. The revenue is definitely going to be received.
Right.
And the expenditure is a positive there being ahead of budget. So we can speak to those, Chair, if you like, on as we get through that.
That's all. You want to go through those tables now then? Okay.
Not so much. What I'll point out is on that particular page 16, the key numbers we look at there are the operating surplus deficit. It's in the middle of the page. And as I said, it refers to the fact that it's 3 million if favourable at this point. And it's forecast to be 3 million less to maintain that through to the end of the year. Now we are in discussions talking about the annual plan and the impact of that. We need to reserve some of that marine fee. So while it's 2 million than expected, it's a perfect timing that we've received it because our marine reserve was running out. We have incurred the costs per year for the last 2 years out of our previous reserves. So the timing is ideal. Our policy is to reserve money in excess of their expenses for the year. So we only budgeted to spend the minimum from the marine reserve, $1 million. So we're intending to put $1 million back into the reserve at the end of the year. So that will account for part of that. And any other benefit from the positive result will of course go into reducing our debt. And we've discussed there that the government funded numbers are a result of timing issues. And within the investment income, red is showing to December that the value of the portfolio had decreased, which we now know has reversed.
Yeah.
Okay. On page 17, our statement of financial position, much as it was in fact in September. There is nothing to note there. unless there's questions.
Any questions on that page 17? Okay, Tanya.
Page 18 outlines our cash flow for the year in a summary form. Cash movement today at the bottom of 13.7 million. Not dissimilar to the previous year. Closing balance at the 31st of December was $20 million in the bank, which is temporary as we look at the next pages. So pages 19 and 20 highlight the seasonal nature of our cash flows. And if we look at page 20, in the middle of the document, there is a government agencies. Next government climate resilience, it's got an end of year number of 10 million with brackets around it. That's our net investment into our climate resilience projects. And that's the primary reason why we get to the end of the year and our cash flow will be 10 million negative. It's our investment into those projects. We intend to fund that negative cash flow with our GFA, Local Government Funding Authority, term debt. And that will be coming in later autumn. As we cross that zero, we're looking at April, thereabouts.
Is that work that's occurring at Mataura? Is that part of that?
All of the projects, Chair. So accumulation of Waihopai, Stead Street, Mataura, and Gore Window. 21 significant expenditure. We break out here the government funded. It is two actual serious projects or significant projects. The biodiversity projects, or we call them Jobs for Nature, have government grants there. For the year, we expect to get 4 million. And climate resilience, which is the ones we're talking about, government grant this year is 6.6. We received 3.5 million to date. We have a local contribution to complete these projects of 10 million this year. And that is our investment on the cash flow state page that you would have seen. Further down, we talk about capital expenditure. Overall, there's sundry plant and vehicles that we buy on an annual basis. And at the very bottom of the page, we talk about major expenditure projects, coastal plan, people, water and land, and the South Water and Land Plan.
Tanya, I wanted to ask a question about that regarding the High Court appeal. Is that going to throw that out, or will it be within our estimates?
That is a good question for the General Manager, Lucy. Unless the CE wants to answer that.
All right.
Yeah, it depends on how many other matters we have in front of us in terms of what we spend. I mean, it's an unbudgeted expense, but in any given year, in terms of what we spend with our lawyers, it depends on what the year looks like. At this stage, I think in conversation with Lucy, we're not certain that we're going to actually increase our expenditure with them. So, it may come in within our budget.
Okay, so you're not too worried about that then?
No. At this stage.
Okay. Thanks. All right, any more?
It's up to you, Chair, if there's any questions on any of the other pages.
I have another question on page 22. Sorry to be dominating things, but the bottom sentence, rates penalties charged 436,000, being a bit higher than previous year at the same time. Is that something of concern or within the margin of error, if you like?
I think the important number is a good question here. The important number in the middle of the page, we put the percentage of rates outstanding as a percentage of the rates that were invoiced. The number at the 31st of December was 14%, very much in line with the last 2 years. Now, unfortunately, what that does mean is that at that period, we still had $4 million of outstanding rates. That's not ideal, obviously, but it's no different to the past. We are continually working on ways of encouraging payment. We introduced the 3 payment plan. We've got a lot of people on monthly payments. We go out of our way to contact people if they get to this default stage. But we do need to proceed with debt collection. 90% of our people pay on time. Therefore, we need to pursue those others and encourage them. We've got a big uptake in direct debits, which is certainly going to help. As you know, we had a change from those paying by cheque. They couldn't pay by cheque. So we did a big campaign on that, and our direct debit numbers increased, and we'll continue to focus on that, which will help. Some people simply forget. It is a relatively small invoice for some people relative to others are struggling, and we're reaching out to them all the time. We legislated to add penalties. It's in part of our revenue and finance policy. We have the ability to remit if there's circumstances that allow us.
I don't know if it's appropriate or useful, but is it possible to separate those ones that are not paying into different categories, like rural versus urban, or industry versus private, that sort of thing? What about that before?
We're interested in a look into that for yourself, for the committee.
I don't know whether you think that would be a good thing to do or not. I don't know if anybody else does. It's an idea that I have.
I think, Mr. Chairman, we're doing what we can to make it easy for people who are struggling. That's a good policy. A lot of people are paying on time, but having to put the direct debit in place is actually quite good, because it normally just comes out. But you know, we have got a listening ear. The staff, if someone's got a real problem, they come to them. They're trying to work with them. So it's percentage doesn't seem to have gone up much, which is good. You get some of those hardcore people who are just not paying often for some particular reason that we still deal with the debt collectors. But yeah, I'm not sure there's a great value in finding out where people live. We know that there's people that rural or urban that do struggle.
Yeah. So you're happy with the way that's been dealt with? Jeremy?
I was just going to make a comment to make sure that the community we work hard with, we don't just turn up with the debt collectors. It's a fairly long process, even three ways of getting the money, the rates paid. So it's just make sure that communication as we work with them to make it happen. So
one of the things that is constantly challenging us is current addresses for people. There's an extraordinary number of people who own property in Southland who live outside of Southland, and some live overseas. So we work with other agencies to ensure that we've got the right address. We have been through here. You can see that we've been active with process where we can. We have the ability within the Act to demand on a mortgage. We do. So anybody that has a mortgage is in default will eventually end up being paid. Those without mortgages, often if you really examine it, you might reflect on the fact that there are sections, vacant sections, perhaps lower value properties in other places where that owner might be absent. So it can be a process to follow through, but we are working for the value of the committee that are unaware of Debt Management Central. They are a council-owned debt management by 10 councils, so it's a local authority shared service. They collect rates debt on behalf of 20 councils now. So they specialise in rates debt. They have servers and processes throughout Southland, or throughout New Zealand, and particularly down here as well. So they're a very good company to work with. We moved to Debt DMC probably 2.5 years ago. They have a very streamlined process, and they certainly send out some very clear messaging to our ratepayers, giving them clear explanation of where they are in the process, what the next step is for them, and therefore what will happen if they don't contact us. And it's the contacting us that makes a difference. If we're in contact and have an arrangement, then we've got something to work with.
Right, thanks. Any other questions on the financial report? Alistair?
Tanya, do you recover that 4 million, or do you recover a portion of it? Some gets written off.
We do write off rates debt. If the property is sold and it's insufficient to cover the debt, then we will write it off. But we have up to 7 years to collect the debt, and longer if if its property is sold and it's above the value. You might note that we do have one ratepayer that is going through the process at the moment that will end up as a tender jointly with Southern District Council. There was one other, but they settled beforehand. And we've even had a situation the other day where a gentleman come and paid us some reasonable money and totally apologetic that he'd received court document and had believed his partner had been paying the rates. So you can't judge people on why they haven't paid. But we're doing our best to work our way through that.
Right, yeah. Okay, anything else? All right, so we have a recommendation to note the financial report to the 31st of December. We'd like to move that. Jeremy? Thank you. Alice, all those in favour, please say aye. Thank you, right. Item 2, thank you, Tanya. Right. Rachel.
Well, through you, Chair, this is the second long-term plan progress report for the financial year, so it takes us through to the end of December. And not a lot of change from the first quarter report, which you may recall which stand for the levels of confidence in terms of achieving performance targets. We remain highly confident of achieving those performance targets last time round, and similar levels of confidence. We've dropped from 49 out of 56 out of 56, and I'll take the consequences in a moment. I just want to know that for some of those performance targets, you will remember the challenges around the fact that they were locked in the long-term plan, and so things have moved, including government reform dates, etc. But if I take you through the key differences, so first of all, we have a green to amber, which is for performance target 14.3. Biodiversity and biosecurity space. I'll put your page number in a second. So this is around the possum control area program. You'll see comments around the size of the program at 387,000 hectares. And the levels of maintenance. Things have moved a little bit since then, so the team have been working very closely, and there is an increase in the area happening. Still some challenges around getting contractor resource and landowners lined up in terms of the maintenance. So Ali advises that, that probably should still remain amber for the time being, just because of the contractor issues. So that is the first one. If there's any questions, Paul can online about some more detail. The second change is in the climate change and community resilience space. So for target 19.1, we've got a good news story as we moved from amber to green. So these are our climate resilience projects. I don't know, Paul, how you're feeling, but whether you wanted to unwell.
Yeah, just to follow on from your comments, that obviously a lot of work has been to meet the timeframes that we've been set by the council and through Kānoa. So we're comfortable now, and you'll see there's been quite a lot of communications around the projects that are underway across all projects, and so that represents progress and alignment with the timeframe. So we're comfortable to be now reporting green.
The last one there has been a change is target 31.2, which is moved from green to amber, and that's the bringing data to life target. On straddles pages 71 and 72, or innovative data services. So we have some exciting things happening in that space with the groundwater data portal and a pilot we can set up on the Irichi River at Lumsden. There's still a wee bit of work to do around an overarching project plan. I don't know, Don, whether you wanted to comment further on that one or.
Yeah, there's a bit more detail coming up in item 4 around both those items.
So very happy to take any questions. Those are the key changes from the last progress report.
Okay, thanks, Rachel. Good morning, Jeremy.
So look, you can see some of those things that are going from amber to green, and I do note some of the reds around the democracy services, like you can make one small mistake and you're out for the year. You know, sometimes it's that we were very hard on ourselves that, you know, things we talked about this setting targets and actually achieving them when they're outside of our control. Some of these things are always going to be weary that it may look bad, but it's not. So it's not too crucial.
Definitely some learnings for the next LTP and set of performance targets.
But overall, looks good.
I had a question on page 37, water and land. There is an amber or orange one there, but it says a clear picture of the state of our environment and where further action is needed. Thinking about the reductions in nutrient losses that are needed to achieve the long-term goals that we have, and these are very substantial, I understand. And I wonder if the community does have a clear picture in their minds of the changes that are going to be required, not tomorrow, but over the medium to longer term. Is that something that we can measure? Do we know from feedback from various meetings that we have that people have got their heads around this and how difficult it's going to be?
Thank you, Chair. So we've been working through an engagement program since late 2021 around the scale of the challenge, and we are moving into the next iteration around that engagement program. So, yeah, looking at a number of pieces of work to really understand where the community is at, and there obviously is a lot of engagement coming out with Plan Change Tuatahi. So certainly there is sort of considerations that we're factoring in. Very happy to bring a report through on the engagement to you in the near future.
Well,
But would it be fair to say that actually that we haven't actually promulgated specific targets by FMU? So in terms of people understanding specifics in the short to medium term, actually they're not really in a position yet to respond to that. You mind saying that's part of the next plan change, why that detail for them.
Alison.
And it would seem that our best estimate of that is 2 years away, as I understand it, in front of our lawyer the other day.
Plan change.
The limit setting will need
Yes.
to happen within the 18 months.
So that's 2 years away. Am I right or wrong?
18 months.
We're getting close.
Yeah,
But you see, the community is going to be in limbo for that period of time.
No, well, I think, we sort of talked about the front end loading process, like that plan change will set limits for the first 5 and 10 years. So we know this is the journey, but once we've got an idea of what the conversation is on a catchment basis, I believe we can go out and have some conversations. Really, it comes down to people what's my issue, actually taking responsibility for it. And at the end of the day, the numbers are only going to affect the bottom 20% or the ones that aren't moving. But I think we probably can, in the next 6 months, go and have a preliminary conversation on a catchment basis. Because actually what we want people to do is not wait, is actually doing what, and most of them have got a fair idea what. If you're a dairy farmer on a physiographic zone that's not great for retention, nitrogen's your issue. If it's hill country, it's overland flows, so your issues probably aren't nitrogen, they're probably sediment, E. coli and phosphate. But having those conversations, I think that we're not going to wait for 2 years to start having conversations, because when you take people on the journey,
there's two different things in what you said. So Stu will make a comment about that. The first thing is that we know what the challenges are. So the challenges and conversation about what action we can take now is absolutely the purpose of conversation immediately. In relation to the item though that's in here 6.1 that's amber is quite specifically in relation to the freshwater accounting system and the time that's taken for this project, as opposed to a broader sense of where we're at. We have a significant amount of information about current state and what the gaps are between the attributes that we actually really need to be focusing on. So that conversation needs to become a much more simple conversation with the community, and that's the focus of the work that's actually going on at the moment in Rachel's team. So there will be a lot of conversation about where to next and what's possible in the next 5 to 10 years to actually move the dial on those. But in terms of the planning process, we're not going to be setting those limits for, that's the work that's carrying on between now and the next 18 months. Not that.
So that goal, or the goal that people have a clear picture of the state of the environment and where further action is needed. People in the community don't really have that yet.
Yeah.
Fair to say.
So there's a level of service that's what we're aiming for. The amber's not attached to the level of service. The amber is attached to the very specific project around the freshwater accounting. So the level of service is something that we've got the state of the environment data is available online at all times. People can see that. That is consistently great.
Right.
So underneath that level of service, the scientific education, the principal operation, the monitoring framework, and the SOE data being available to everybody, that's all great. So it's very specifically the project plan has been underway and the freshwater accounting system target was that it will be live from 30th of June. So there is some doubt we're going to complete the process in that time frame for that project. That's the only amber.
Yeah. Jeremy's got a question, Mr. Chairman.
Oh, thank you, Mr. Yes. Thank you, Jeremy.
The reality is, I suppose speaking within the rural side of things is we're obviously going out with some numbers saying, hey, these are the environmental challenges. But the reality is we can't individually tell them what, excuse me, what that actually means on the ground as yet, the direction of travel. And that's probably there's a bit of a discussion people do want to know, trying to make sure we get it right. And in the future, obviously, Climate Change Tuatahi is going to start heading that direction. But as of at the moment, we're throwing some numbers out there, but it's not really clear what will need to be done. So
perhaps flag that your original question could generate an interesting metric that might be woven into future long-term planning efforts once people are aware or once the topic is informed of what the targets are at catchment level. It'd be interesting to pursue, the level of awareness across the community of what those targets are. So I think that would be potentially a future metric we could consider weaving into that.
And perhaps what people need to do and whether we're doing it, that should also be a metric that comes out of farm planning we should be capturing as well. So there's a lot of, in the we're going to be quite busy in the next 2 years on this because we'll move to the, not just discussing with the plan what those limits are, but the actual conversations around how the farm plans will be rolled out beyond the ones we currently have and what those metrics are and how we look at them. I think those are things we should look at for the LTP as well. What people are doing, whether they're doing the things they say they will do, that's and what impact they're having. We're not joining those metrics up yet. So there's quite a bit that, as you say, there's been learnings from this LTP around what some of those might look like for us. Whether they're actually part of the level of service or not, doesn't matter, but it's maybe reporting that would come through to perhaps the Regional Services Committee around the outcomes of those.
Okay, thank you. Anybody else? Sorry to miss those questions before. On page 55, Rachel, relates to the review of the regional policy statement. And that, I imagine, some kind of roadblock there to do that. That's not totally within our control. Is that right?
That's right. So this was one of the matters I was alluding to at the start of the item around the fact that there's been some changes at the national level which have flow-on effects to us. So in this case, the National Planning Standard implementation deadline has moved out, which affects our regional policy statement review. So that's the reason for not advancing this one into the original timeframe.
So that'll stay as read, I suppose, because of that reason. Is that possible then to alter that so that we can actually achieve what we wanted to achieve?
We had a conversation with the auditors about this one the other day. It's been a topic we've covered with them a number of times. We could, in theory, make a change through the annual plan process, and that's just then whether it's significant, well, yeah, whether it triggers the significant material change aspects of the annual planning process and the consultation you would then do with the community. So we are looking at that.
Okay. Page, excuse me, page 59, climate change and community resilience. It's green there. There's no performance measures or performance targets on that table on that page. And the question I had was, will this help with our flood protection? Can you explain why we don't have? Well, that's part of that. Is that part of the table
Roll
above?
across the page, Morris, I think is the problem.
Sorry.
It's a roll on from 19.3,
Yes.
which is a scheme per year.
All right. Yeah. Okay. So there. You're right. Right. That's about all I have. Anybody else got any questions of Rachel? Anybody?
Just on that whole piece I see on the coast and marine, we're sort of in that amber colour, but it's sort of COVID and a few other reasons we're probably just slightly behind where we are, but we are progressing slowly.
Okay. All right. So we recommend that we note the 3 monthly long-term activity progress report over this year. Would like to move that. Jeremy, seconder, Nicole. All those in favour, please say aye. Aye. That's carried. Thank you, Rachel. Right, now item 4, page 78, the information management update.
Good morning, everybody. This is our update in regards to the past quarter. We just actually asked that you actually note the report is read. We do have some highlights. I'll address the IM highlights and then I'll hand over to my colleague here, Jane, to actually address some of the IS highlights. So firstly, with regards to IM, the team has definitely commenced work on the draft IM policy to actually support the IM strategy. The aim of the policy will be to address the management of information content in the systems and to provide guidance to help achieve compliance with public records and information and records management standard. The policy will address how we work with Microsoft 365, in particular to using OneDrive. This system, Microsoft 365, in its native form is not compliant with the rules, so we actually provide standards around those systems to make sure that we actually provide that compliance. Probably another highlight is the fact that we're starting our digitisation pilot project. That's going to kick off mid-March. The proof of concept pilot is really about identifying the true benefits to the organisation to actually further digitise broadcast information. It's not just about compliance to preservation and digitalisation. We continue to see benefits and efficiencies of implementing workflows, automations across the organisation. It's really benefiting teams right across the organisation to actually automate processes that are in manual. In particular, our onboarding workflow has been really successful across the organisation. It's really assisted all teams, team leaders and managers. And work is well and truly underway with regards to our next upgrade for our records management system Objective, and that will be rolled out in the beginning of March.
Thanks, Paula. Any other comments, Jane?
Yeah, so just moving on from that, and it's probably following on from Rachel's report on the Amber for bringing the Data to Life project. We've discovered that there's a bit of a integration layer that needs to be created, and so we've got that in a pilot right now. So we see that project ending up in a green by the 30th of June. So that's really good news, and that's enabling mainly our consultants to come in and self-serve for all those data requests that they give to the data team. So that's what that project's going to bring. And so that's focusing on, in the beginning, just around the groundwater data requests. So that will enable that to happen nice and easily. I think the exciting one is, if you look on page 80, is the wonderful photos that we're seeing that are coming from the pilot camera that's in the Lumsden Cableway. And the clarity of those photos, we went into high flow. I think that was about November-ish. I think we had a bit of rain back in November, and so we were able to. Those cameras move, so you can move the camera around. You can have a look at the state of the river. You can have a look, obviously, at the level of the river without having to actually somebody to have to drive to Lumsden, an hour up there, an hour back. And so we see that some of the health and safety and the cost savings, and that will be immense in that space. And they are currently looking at, I think there's about 4 rivers that they're looking at. I know that the Waihapai Dam's the next one that they're going to pilot. So that data is going to be available on our website, and you'll be able to see it. I'm not sure if it'll end up being a live stream or a 15-minute intermittent, just discrete data that's captured, or I'm not quite sure where that's going to land in the end.
Thank you, Jane. I'm sure that'll be good for anglers too. Sure.
Question, and it's interesting this came up because there were a few things in regards to what we're dealing with and having cameras and that. One comment, and I don't know whether it's true, there's lots of stuff going on, but it was a question I asked in regards to this. You can see this at night. Can you view this at night? Are they able to be, this was a comment that the cameras weren't able to be used in the dark.
Correct. I will check.
Because a lot of stuff happened at night. And
Yeah, I will check what the infrared quality is like on it.
That's something we can probably learn from.
Yeah, no, that's a good point, and I'm not sure of the answer on that, General.
Just following up on that point, Jeremy, the team are looking at a lot of things up north about looking around, reassessing the power supply, location, accessibility, all of those things. They're just being revisited in a lot of some of these things. So I'm sure that night vision is coming into it as well.
Great to see.
And I know that like privacy, the privacy statement's been readdressed and had a look, made sure that we're not breaching any privacy or anything like that. Doing something in front of the camera that you shouldn't be doing.
It's actually just ensuring we have the software and the capability to pixelate if anybody requests anything around privacy, and we actually have ensured that we do.
Yeah.
So you would have to make sure it's not a popular swimming hole where people.
Yours was. Especially at night.
Not just reflecting on some of the issues in Hawke's Bay, I think this is all internet, and it's obviously one of the learnings out of there is what happens when you lose connectivity and you're not getting any information, no communication. I guess we won't have much backup, and some of our rivers we've still got the telephone thing. I don't know if they would still work or not on a landline. But
So we still have some analog lines. all of these sites we're piloting all have solar with them, so as long as the sun's shining of some form, and a lot of them are driven off like an old cell phone, so you know those bigger cameras, I think they've got built-in solar. So it's something that we're definitely looking at.
Jane?
Probably a question reflecting a little bit of, in fact, I'm a new councillor, in terms of automation, probably beyond the realm of reasonable expectations to be able to automate responses to ratepayers who phone up and complain about a particular issue, but is there information management processes that help us track how complaints are being responded to, or have been responded to, or consistently responded to?
Yes, so outside this open bringing data to life project, all complaints are lodged through IRIS, being our regulatory and request system. So, and there's reporting on that, and certainly the customer services team. And once that's established, more fully established, there will be more rigor around that. But yes, there's definitely reporting around how many complaints we have, and we get employment on that.
Right, and I guess I was just kind of more interested in our track. Has someone had a complaint, have they had a satisfactory response, or have they had a response to a complaint if it's been passed around different departments as we work out who's actually best placed to answer or respond to a complaint?
Yeah, and I'm not probably the best person to answer that, but I can get feedback on that.
I can answer that for you.
There we go.
So we could create an automation in that way. At the moment, that currently doesn't exist. So there's multiple ways you could do that. You could do it on the correspondence coming in and then automate the loop to close that to say they've been responded to. So it's definitely a possibility. And what I can say is that we have a very good team who create workflows. So that's a nice suggestion. We'll take that for them. Thank you.
Thanks, Bill. Anybody else? So you objective. Oh, Lyndall, sorry. Yes, Lyndall, sorry.
Just to follow on from Councillor Martin's point, actually, we also great track good feedback that we get in a similar way.
Yes.
I'm sure there is. But my actual question is, what is our data connector? Yes, so that custom data connector that you're
So that's
building.
so this is the integration. So yeah, the integration layer between the two things that we talked with. So Wells and sits in one database, and the other information sits in our top database. That's that connection. These two systems together. Yes, we do have a brilliant creating that. So I apologize for the terminology and
It's quite a lot of terminology.
yes, it was, yes. Are there any questions on the rest of the report? Is, you know, we're making slow progress on that customer, verifying our customers, and we see an increase of our website, particularly, you know, if you look at the graph on page 82, you know, that's rates times. So as expected, we would see an increase of the number of people that are landing on our page. We're continuing to have additional online forms that have been developed. So as the request for, you know, that comes in, and the technology plan is Dom and I are working through that. We've got a very first draft and second draft coming this week. So yeah, it's making some progress in the last. So that's all I had to report on my section. Any questions?
Anything else? That big drop off in the user activity was interesting. Maybe everybody was on holiday then.
Yeah. Yes, it does dramatically decrease.
Okay. Right, so we'll go then to.
Sorry, really quick.
obviously, is there seasonal, like, I mean, that's book season. And almost prediction that you're gonna get the, so you get problems out before it starts.
Yeah, so we'll see, and when annual targets go out, you'll see a huge increase when we send out the rates, obviously we get an increase, the white bait season we get an increase, and the dairy packs that go out, you know, so they are very seasonal, they're very predictive on what. And so we try and, you know, the comms team work hard at trying to get that FAQs out there so that we can try and cut down some of that traffic. But what we're actually seeing is a whole lot of people actually registering to be online customers. So they're actually, so they are on, and what we haven't reported is our online customer interest of that sense that we reported live and last year.
Probably gonna be hugely important, like getting people online, that's getting information out there in the future and everything.
Yeah, so we can actually improve that state. We're going to see that increase of our online customers engagement. Yeah.
Thanks, Chairman. Just looking at wasn't even aware, shamefully, of the Te Kawanatanga or Aotearoa strategy for digital public service.
Yes.
Which I've just been looking up. And well, it have given me some homework, but I'm just wondering what resource assistance we get in order to meet that strategy from government.
Yes, so that's a piece of work that we're working through on the digital SIG as well, so that national group through RSHL or the ISSO group, you know, it all connects all in together. And so it's in its infancy and we are trying to join all the dots.
So digital.gov.nz, do they put any? Those expectations?
Not that I'm aware of.
Good, eh? Must fit it.
Yeah, and it's certainly a document that we are using, and that's, you know, some of the trying to get the regional sector aligned with that as well. Yeah, and us trying to stay on that same trajectory of delivery. It's complex.
Thanks very much, Paula and Jane, for all of that, and I'd like to ask somebody to move that we resolve to note the activity and progress in delivering information management systems and technology within the council. Nicole.
Happy to move.
Second it. Bill, thanks very much. All those in favour, please say aye.
Aye.
It's carried. Thanks again. Right, item 5, the annual activity plan. Yeah.
I can start by making sure that we're exactly on time. So. We had a clock. Yeah. I'd like to nominate it.
Was that only right? It was a day anyway.
What application to the budget?
We will. Twilight. The finance and performance activity report timetable for 23, and then over the page, notes. There is nothing to note particularly here. She says that's the wrong phraseology. There's one thing to note here, that we've moved the date for the May meeting, 11th of May to the 24th of May. Changed it. Added earlier, apologies, it didn't get onto your calendar. That is important to give us end of quarter. Give us enough time at the end of the quarter that counts out the non-working days of Easter and have them go through the system to be checked off by management. What we're looking at is programs similar to last year. Group into quarterly reporting, annual reporting, other updates, investment update, which you've heard from today. We're proposing that JB Weir come in person in February. Fleet manager will be reporting to you in May, and in May we'll give you an update on our strategic asset review. It's early work on our long-term plan. And will include investment review, investment manager review. At that point, it won't have been completed, but that'll give you the timeline for that. And the SIFO review, which is our statement of business policy operation. Over the page, we have it's outlining that for the first line, the policy reviews. They actually sort of sit between 23 and 24. Apologies for not picking that up. So as part of the long-term plan development, we go through a review of our, as it says there, our policy, our rates, treasury, revenue, finance, and we've already started the investment review. Representation review due 4, that sits with democracy services and perhaps planning. And then the section 17A review, I don't know what that acronym is. I believe reference is talking about under the Local Government Act, regional councils are obliged to review all their activities on a regular basis to consider whether or not it's appropriate for them to be operating in-house with that service or whether it's appropriate to have community contracting or shared service, whatever the best alternative is. It's not sure why it was unique to regional councils, but it was part of the Act. It says it's timely that you keep an eye on the parts of your job and review the appropriateness of your delivery. Can be a desktop exercise, can be as significant as it be. Auckland Council, I had the opportunity to hear their CE some years ago, and he has a rolling section 17A review, which basically looks at parts of the organisation on an annual basis and just puts them under the microscope a little bit to see if it's appropriate for them to keep doing that. So we've in the past, Ken Swinney, a corporate planner, the last set of reports on that. Then there's the representation review, highlighting again. For Wellbeing's report, triennial report. Now the triennial agreement will be underway already, I believe. I've seen notes on that. That's comes about as a result of the elections and new representatives. It is completed. Yep. And Rachel's not online. She might have been able to speak to the Charter of Understanding. I think that's underway. Yeah. So that is the plan of forward work, and we haven't brought forward any new items to be proposed yet in this new committee and finance and control. We did toy with the idea of bringing a deep dive each quarter into one of the groups of activities, one of our portfolio groups. That we'll continue that discussion with Rachel and the team as to whether there's things they want to highlight in more detail than just levels of service. So that is under review as we look around the country and see what other performance reporting is going on. Question I have for the committee is it's a 2-hour meeting at the moment. Are you happy with that? We don't extend it too long. Is there something that we could bring to your attention?
Cool. Broadly, a question, I guess, and welcome thoughts and guidance on this one, but I was wondering about HR trends for the organisation. There's something to monitor or manage and watch Because I imagine the talent available to you as a organisation can influence your performance in the organisation. I'm aware of some government agencies, departments that have had either rapid growth or are suffering very high attrition rates in recent years for whatever reason. That can speak to your cultural performance. So just wondering if amongst this list is certainly for this committee, there's no reporting on churn or turbulence or vacancies, replacement rates.
More an audit of risk than on the spot, this one, which is more the financial right. But a good question, we covered there with it. So.
Mr. Chair, Amy's come online, I think, with her hand up to speak.
Yeah, all I was going to say is, you know, we're always happy to come and talk to the committee. I guess it's for you to, or for us to work through which committee, as Nicola was saying, is best for us to report to. When the committee was a joint committee, formerly known as OPAC, managers did come in each meeting and do a deep dive on the area, specifically with respect to areas of risk. And HR certainly has featured in reporting back through to the joint committee there on those matters. Internally, we are shaping up some work, and I'll let Dom talk to that in terms of our performance metrics, not just from an HR point of view, but more broadly across the organisation. So I'm happy to have a conversation with individuals or members of the committee to work out specifically what you'd like to see, and then bring it to either committee, risk or finance and performance as you see fit.
Wilma?
So, Mr. Chair, I think the area that we have been talking about, and I want to see a detailed report come to you on every finance committee, but also to every risk committee as well, as in relation to all of our cash related programs that are crowd funded. So we have internally a governance group that looks specifically at those crowd funded projects, both in terms of Jobs for Nature and in terms of the shovel ready projects. They come with a significant amount of expectation from government in relation to reporting. So it's important for us that we actually do ensure that we are meeting all of the standards that central government is expecting of us. I'd like us to be able to report separately on that to you. I think that's a significant part of our budget. And there's a significant risk component. Our intention is to bring that to both committees, the risk element and the financial element. So I think if there's going to be one deep dive, it is the biggest part of our expenditure at the moment. It's a key focus of our work, and it's also a key focus of our risk. So we'll bring a report from that governance group to you, and the governance group set up normally to be able to feed into this committee. But the beginning of the financial year has not made that possible for us a calendar year to meet in time for this committee meeting with our externals in the room as well. But that should flow through for the rest of the risk and finance auditors.
Would you add that to that table then?
Yes, that will be added to the table.
Okay, thank you. Sounds that would be very useful. Anything else?
Happy to move the resolution, Mr. Chairman.
Okay, thank you, Nicole. So the resolution is that we council review the annual activity plan, provide input and results we noted, which I think we've done. Or second it, Jeremy. All those in favour?
Aye.
Aye, carried. Thank you. All right, I think that's the last item, is that right, Don? So I'll declare the meeting closed, and thank you for your attendance, and thank you, Tania and the staff for your contribution. It's been very good today.